Now let's talk about accumulations phase. Now, when the market go into consolidations, there are two phases. One is the accumulations and one is the distributions. Now, the reason why we see accumulations is because the bank, the institutions want to accumulate and buy as much as possible at a low price and prepare to move the price higher. And why the bank need to do distributions? It is because the bank have already purchased right at the low, and the price is coming down, right? In a downtrend, in a very bearish market, traders are all selling. And until certain level, you see the price start to stabilize and it found a bottom. The reason is because the big institution banks start to step in to buy. Now, why they want to buy when it is in a downtrend, a bearish market? Because the bank know this market. They know that this is a price that is cheap enough, and they are willing to step in to support the price. And because they step in to buy, they start buying, the bearish market start to stabilize and start to turn into a bullish market. So during this phase of where markets start to stabilize, right, where the big bank, the institution, they start to accumulate as much as possible at a lower price. This is a phase we call accumulations. After they have accumulated enough positions, the bank need to take profit. So what they will do is they will engineer another move up. We call this markup phase. Okay, and up to a certain level, if the bank think that this is a level they want to start taking profit, they will start to engineer another consolidation phase, which we call distributions. During the distribution, we'll see the bank start to buy and sell, but they will sell more than they buy, which is the opposite of during accumulations. During accumulations, they will buy more than they sell, right? So during distributions, why the bank need to distribute? Because they want to offload the position they have bought it at the low price. Right now, the price is right at this level. They want to start taking profit, and that's the reason they start to distribute, right? So after distributions, we know that the price usually go down. After accumulations, the price usually goes up. Let's talk about accumulation first. Now, during accumulations, there are two types of accumulations pattern. Now, in the downtrend, down market, we see the price coming down, right? And until certain level, we see that we will see that the price until in the bearish market, right? They drop until certain level, suddenly they stop dropping and the price start to move up. Okay, and this is called the selling climax. Okay, now before the swing high, before the support, there's a pullback here. We call this preliminary support, and then after the selling climax, we see a automatic rally, and then the price come down to do a secondary test. Now this is under phase A. Okay, this under phase A is where the price in the bearish market and the price stop moving lower and start to have a very shadow pullback, right? And then conduct the first test. This come under phase A. Now during phase A, there is no trading opportunity for us. Now during phase B, we start to see the price start to trade within the range, right? The price will start to come back down to test again the previous low, and it start to rally back up. But this rally back up usually contain within the automatic rally high and preliminary support high, and market start to move lower, right? So this is phase B. Again, during phase B, no trading opportunity. Then we come to the phase C. Now in phase C, we tend to see the price start to move lower than the secondary test, lower than the selling climax low, right? We call this spring, right? A spring. This spring usually make a low lower than the previous low. The reason for this spring is to stop hunting all these low that below here. Now, why we have a spring? Because there are some trader that after they see the price after a bearish market, such a huge drop, they also want to come in to buy. They want to buy at the low price. they are waiting for price to go back up so they can make a profit. So if they buy here, they buy at whatever level here. So if there are a lot of buyer here, where do you think they put their stop loss? Well, their stop loss is going to be at the swing low, at the swing low, at all the swing low, right? So as I explained just now, why the bank need to do stop hunting? So that is the reason, because they want to get rid of all these stop loss, to get rid of all these early buyer, right? So we have a spring. This spring serve the purpose of stop hunting, right? After spring, we will see a test. Price will rally and then come back with a test, right? Now, if you are trading with Wyckoff in detail, you are trying to trade, you are trying to capture Wyckoff. This is your first opportunity to get long the test, right? But of course, this kind of when you want to trade with Wyckoff methods, you must combine with the volume, right? But for here in our program here, I do not want to go into such a detail to talk about how to get into the test and spring. But what I want to explain here is the different phase of accumulations and where we want to get involved in this accumulation phase. We are not going to involve in all this phase. As long as the price trade within the range, within this trading range, we are not going to involve. We are going to wait until the price break out of this trading range, right? Or break down. It depends, right? So we are waiting for this trading range to be complete. So whatever happened inside in the trading range, we are not interested. Okay. So to make it simple for you, right? So once the price decide or the bank decide to break up to the upside, we can see that usually this kind of break will combine with a big, very big bullish candle. All right, like a ERC like that. Okay, and usually the closing price of this candle is also above the all this swing high or automatic rally, right? You can see there is like invisible resistance, right? And usually all this candle close will be much higher than this resistance, and it is very obvious. You should not miss, right? And after this ERC, we tend to see the market start to pull back and go into a consolidation phase again, right? So if price goes up and the price pull back and go into consolidation phase. Now, during this consolidation phase, all right, this is a phase that we call backup. Backup. A backup is a phase that come under phase D, right? During backup, we will see the market start to test this trading range. Okay, it start to test this trading range, and we will try to enter during this backup. Right. So in this backup, what we're going to see is we have a trading range like this, accumulations. Okay, and the market break to the upside with a big bullish candle above all this resistance. Okay, and then after that, the market tend to pull back and do a consolidation in a very, very narrow range again before breakout again, right? So it is during this phase you can go down to a lower time frame, right, to enter the trade here. Or if the price already break up above this backup range, you can always wait for price pullback in the future, right, and to long at the backup and stop loss below the low of the backup, and then we expect price to go higher. Okay, so the way we're going to participate and involve in the accumulation phase is after the breakout, and get involved in the backup phase when the price inside the backup, or when the price break out higher and come back in the future, right? So this is under phase D, and once the price has break away from this breakup, right, in future under phase E, it might come back to test, it might not come back to test. Okay, so this is one accumulation, one schematic about accumulation, and we tend to find this very often, right? Now the other type of accumulation is very similar, but it is the only thing that not the difference between the two schematic is the second type of accumulation. We call it schematic 2. they don't have this spring. They don't have a spring. Okay, let me show you. Okay. Now this is schematic 2, accumulation schematic 2. Now very similar, you can see in the bearish market, right? We have a selling climax, which have the volume usually very high, but since we don't talk about volume, so we don't really care. But what you can see is the price in the downtrend, right? And then price start to go stabilize. So immediately you can pick up that this is a selling climax. This is a preliminary supply, and this is an automatic rally, right? And this automatic rally, usually you will rally towards this preliminary support, but not higher than preliminary support, right? So in order to recognize, to identify the preliminary support, you need to be able to see the selling climax first, followed by automatic rally. Then you're able to trace back where is the preliminary support. All right. So the same thing, after the automatic rally, we tend to see the price come back down to do a secondary test on this selling climax. Then you go to the phase B. Now in phase B, we'll see the market test the high and fail, and test the low and fail. Right? Again, another secondary test in phase B and pull back. Right? This test again is a stop hunting. Do not confuse with the break of structure, because when we see the markets in the accumulation phase, right, we tend to see a lot of stop hunting, and this stop hunting can be confused as a break of structure. Okay, so during phase B, we see the price start to trade in the range again. Okay, and then during phase C, we start to see price come to test again, but this time we do not see any spring. The market just make another low, try to test this low and try to test this low, and then after which the market start to slowly move higher. Right, if you go down to a lower time frame, you were able to see there's a break of structure here, right? So you can see we have a low and become higher low and higher low, right? And the market will slowly grind towards the upper limit of this trading range, and then we'll see a big bullish candle, the same thing which I explained, right? A bullish candle that trade and close above this trading range. And where do we get involved in this? Again, the same thing. We do not trade until we see this break above the trading range and the price start to pull back into a range again. And during this narrow range, which we call backup, right? We'll try to get inside this range in a smaller time frame, or wait for price to break above outside breakup. And if in future, if the price start to pull back into this backup area, we'll go long, right? So these are the two accumulations of two type of accumulations that we commonly see. But of course, you are not going to see this. These are typical two type. But of course, when you come to real charts, you're going to see a lot of many other variation as well. But you can basically these are the two. But it will not deviate that much. Okay. Now the other type of consolidation pattern is we call distributions, right? Now, in the distribution phase, it is the opposite of the accumulation, where we see the price in the bullish market, and then we see price is pushing higher, right? And until higher until we see a buying climax, right? And this buying climax is always combined with a very heavy buying volume. And then after a buying climax, we will see automatic reactions, which is the opposite of automatic rally, automatic reaction, right? Once we locate buying climax and automatic reaction, we were able to locate the preliminary support. All right, this here, and then we see the price start to test the sign of weakness to test the this automatic reaction, but it failed to follow through, and the market start to pull back up. So we know that this is a stop hunting, right? And it moved back up, and this after the price moved back up, right? We see the market will surge higher than the buying climax. They will give the impressions that the market is very bullish. So a lot of traders who are on the sideline waiting for this breakout trade, with the moment they see the price surge higher, before all this happened, right? This is a bullish candle. They start to jump in or put their buy stop and think the price is going higher. But to their disappointment, the price make a reverse back down, right? So this is a UT is called upthrust. Upthrust, the intention is to stop out those stop loss above the buying climax and sometimes the secondary test, right? After upthrust, we see the price turn back into the trading range again. Trading range in this consolidation is defined between the buying climax and the automatic rally or this or secondary test. That this is the range we're talking about. Okay. Now after the this upthrust, we see price trade back into the range, and you will continue remain in the range, and then sometimes the price will start rally again, right? Giving the impressions that market is going to break out again. Now this is the Utah, right? This is the final upthrust where usually this is a much bullish candle. You see a very obvious bullish candle pulling up, right? And usually when they give the impressions to the, you see this like this, yeah. You see, you give impressions to the trader that a market is really have a breakout, but actually, and it will induce a lot of trader which on the sideline start to come in to buy because they worry they miss a trade. They start to jump in to buy, either buy the market, buy stop, they start to buy, right? But this is the final engineer move by the institution to lock up the retail trader at the high positions, right? And after the bullish move, the bank will start to sell, throw in the big sell order, and the price start moving lower. And all these people who misled into buying, right now they regret. They realize that they actually get trapped at the high, right? So this is again, this upthrust is to stop out all these stop loss. Why we have upthrust? Again, the same chapter which I mentioned. Why the bank need to conduct stop hunting? Because the bank want to get rid of all these seller. There are early seller who sell here and their stop loss is above, right? So the reason why they want to get rid of the seller is because if they don't get rid of seller, and in future when the bank start to move the price lower, all these seller they are taking profit. It's actually a buy order. When the price hit, they are taking profit. This buy order it's actually a buy order will try to obstruct or will try to block the price from moving lower. Okay, so again, bank want to take out all these early seller. That's the reason they conduct upthrust and Utah. Now, usually after Utah, we'll see the price start to make a lower high, lower high, right? And eventually, it break this automatic preliminary support, and then price start going down. Now, after price break this support, the trading range, quite often we'll see a price start to pull back. Either they pull back to this previous support, now become a resistance, which allowed trader to get into the trade to ride the trend down, or sometimes the price might pull back all the way inside into the range before move down. Okay, so how and where do we get involved in this distributing? Now we will get involved when the price, after the price has already convincingly break down below this automatic reaction and the swing low here. Once it convincingly break down, and as the price start to move back up, okay, we will start to look for, is there any gap that need to be filled? Is there any trap order that need to be unlocked? Then we will take our position accordingly. Maybe if there's a gap over here, okay, we might want to put our sell limit, okay, and then our stop loss above the Utah, and wait for price to come and take our order and then go down. Okay, so whatever happened inside this trading range, again, we are not interested. Just like the accumulation, we are waiting for the price to prove to us that they want to take the price lower, which is a break down below all these low and the automatic reactions. Then price pullback. That's where we want to get involved. All right. So these are the two consolidation pattern. One is accumulations and one is distribution.